Investment Returns, Fraud, and Bernie Madoff. This is Ken Boyd. So if you want to impress a day with your knowledge, take a date to the escape room, one that you've already visited, you've already been to. Escape rooms are fun. A group of people receive clues and decide how to get out as a group. And if you want to dazzle your date with your knowledge, you can visit the room in advance, remember the answers, and rattle off some of them. But is it really possible to know 4 to 5 escape room answers and come up with them so quickly? Probably not. So your skepticism should serve you well, and that skepticism relates to fraud and Bernie Madoff. So kicking the tires. I recently heard Tim Ferriss interview Ed Thorpe, a successful former hedge fund manager. In 1991, he was asked to review the investment portfolio of McKinsey and Company, a name you may know, a global management consulting firm. So his job was to kick the tires to see how things were going, and specifically, he reviewed the investments in the company's profit sharing and pension plans managed by Madoff and Company. So what stood out? Well, the red flag was consistent, and that's the key word, consistent monthly returns. Barron's explained that one investment generated 1 to 2% monthly returns consistently for years, a track record going back to the late 1960s, and that's a red flag, and here's why. 1 to 2% translates to a 10 to 12% annual return. If the portfolio was invested in stocks, the portfolio manager might be able to generate returns similar to the S&P 500, a basket of 500 large company stocks. What return would the portfolio generate? Well, Investopedia states that the average annual return since its inception in 1926 until the 2020s, the average annualized return is about 10.6% between 1926 and 2021. Okay, so 10% seems reasonable, but here's the problem. Generating a 1 to 2% monthly return consistently isn't possible based on the fluctuations in the index. In 98, 97, and 98, for example, the total return on the index was around 30% each year, but in 2008, it lost 37%. It isn't possible to do the return consistently and generate it month after month. So the question is why? And McKinsey's response is, we don't know exactly. They tell us they won't explain what their method is, but we can show you our accounts. Okay, so let's dig deeper. The investment statements reveal that Madoff bought stock and used S&P 500 index options to hedge the risk in the stock price, and that the options trades always worked. Again, a red flag. Peter Madoff, Bernie Madoff's brother, was managing the firm at the time. He would not let Thorpe in the door to find out anything further. After digging deeper, Thorpe found that half the index options trade listed in the statement simply didn't occur. Specifically, the options never traded at the prices listed on any exchange on that day of the trade. Thorpe confirmed the data with another brokerage firm and told McKinsey that the investment statements were fraudulent. It took some convincing, but Thorpe was able to get McKinsey to end the relationship and withdraw the funds. So the emperor had some clothes for a while. Bernie Madoff was a respected member of the investment community. He was the former chairman of NASDAQ, a big industry organization, served in a lot of committees. And his firm was a large market maker in stock trading, facilitating stock trades. He had thousands of investors, and he had a lot of incredibility. But eventually, the emperor lost his clothes. In 2008, 17 years after Thorpe reviewed Madoff's trading, his fraud was exposed. He operated the biggest Ponzi scheme in history, which may be eclipsed by the Sam Bankman-Fried fraud. We'll have to see. And quoting, he defrauded thousands of investors out of tens of millions of dollars over a course of 17 years and possibly longer. He died in prison in April of 21 while serving a 150-year sentence for money laundering, securities fraud, and several other felonies. So what's the lesson here? If something seems impossible or just unlikely, pause and think, how exactly is the person or business achieving these outcomes? If it's a scam, they probably won't tell you. So food for thought. If you'd like other great content on accounting and finance, you can visit and subscribe to